All right. Well, this is the second installment of, I'm going to workshop this title, Better Appreciation. So, I'm a financial psychologist and wealth manager, focusing on positive psychology and looking at strengths and how we can appreciate the things that are going well and enhance our strengths. Kenny Gatliff, portfolio manager, investment manager. Anything he touched turns to gold. So, he's all about that appreciation, right, Kenny?
Yeah, I don't think we're allowed to say that compliantly, Dan, but yeah, I'll take it.
Just kidding. Just kidding. All right. Well, it's better than dollars and cents. Dollars and cents was a little basic. So we'll see if better appreciation uh, has some teeth to it. Okay. So, Kenny, thanks again for joining. And for those of you out there, if this is the first time you're listening, Kenny and I are going to try and keep these conversations well below 10 minutes, but just answer some basic questions. So last month we got on and we talked about the Dow Jones being at an all-time high, the S&P 500 being at an all-time high, and what that means. So we're even going to take a step back and ask what is the S&P? What is the Dow Jones? Kenny, before I throw it to you, when I was younger, didn't know much about investing or finance, I would hear them talk about the S&P 500 in the news, and I just assumed that is the market. So can you talk a little bit about what the S&P 500 even is and what the Dow Jones even is?
Yeah, sure. And I think it's kind of one of those common misunderstandings. And so I'll start with the Dow Jones, and so basically, 130 years ago, I think in the 1890s, the Dow Jones was created. It was 30 of the biggest, most prominent U.S. stocks, and it was truly just created as kind of a proxy for the stock market because information was sparse back then. It was hard to add up all of the values of all the stocks and create a true stock market. So they said, okay, well, let's just take 30, look at how their prices are moving each day, and that'll give us a rough understanding of kind of what the U.S. stock market is doing. And fast forward a little bit, then we move that from 30 stocks to 500, and that's what the S&P 500 is looking at. It's essentially the 500 largest U.S. stocks, and so
So
that
is,
gives us a pretty good understanding of the stock market. But it is limited, to your point, in that it just does represent the largest 500, and oftentimes the large stocks move differently than small stocks, and so it can be a good measure, but it's not a complete measure of the stock market.
yeah, okay. And is there overlap between the S&P 500 and the Dow Jones? Are there the same companies in both indexes?
Yes, yeah, there's going to be overlap in there, and again, just the S&P 500, if it's the 500 largest, the Dow isn't exactly the 30 largest because it doesn't
Hmm.
roll over anytime there's a movement in price changes, but it's 30 of the largest, most prominent, so it's going to be you know represent a lot of the same companies there.
Okay. Yeah, that's helpful. So if those kind of represent the largest US companies, what are some of the other indexes or asset classes that we want to be mindful of?
Yeah, I would say ones that are really important to look at, as I kind of alluded to earlier, is not just looking at large stocks, but looking at small stocks. And the most popular way of looking at it is through the Russell 2000. So Russell kind of expanded that on that idea of the S&P 500. They said, look, there's essentially 3,000, give or take, listed stocks on major exchanges in the United States. So they came up with a list of the Russell 3000, and then they broke that down further and said, the Russell 1000 is the largest, and then the Russell 2000 is those kind of mid and small cap companies. And so there's going to be no overlap pretty much between the S&P 500 and the Russell 2000. So if you're investing in the S&P 500, you're essentially getting the largest US companies. If you're investing in the Russell 2000, you're getting the smallest US companies. And so it's really good, from our perspective to say, okay, well, those are measuring two very different things because there is no overlap.
Got it. Got it. Yeah, thanks. That's helpful. So I've worked with you long enough. I know, when I look at a portfolio that you're putting together, you've got, large US companies, small US companies, international companies. You've got these different asset classes, but
Mhm.
it's not the same ratio or percentage of each asset class in the portfolio. Why do we have different percentages or ratios of these various asset classes or indices that are represented in the portfolio?
Sure. It's a little bit of an art and a little bit of a science. So you want to broadly measure the US stock market. And one thing I didn't mention is that, when you look at the S&P 500 or any of these, they are market cap weighted. So it's not 500 stocks with equal weighting. It's, whatever your representation of. So if Apple makes up 10%, of the market. Well, it's going to make up 10% of the S&P 500, even though it's only one of 500 stocks. So the downside of investing in only the S&P 500 is you are getting pretty overweighted toward just those largest stocks, not just the largest 500, but the largest 20 stocks. So you want to expand outside of that from a diversification standpoint. So the way the way any portfolio manager or investment asset manager is going to look at this, like I said, there's a little bit of an art in saying, okay, we want to make sure we're getting the broad market, but we want to get some representation outside the S&P 500 too. So, if you got a full broad market, you would be and said, okay, we just want to own, a market cap weighted portfolio of all of the stocks. Well, you're still going to be extremely heavily weighted toward those top ones. So you want a good representation of that. But when we look at our portfolios, you're going to get small cap, you're going to get international, you're going to get emerging markets in enough ratio to be able to offset times where the S&P 500 might be underperforming, but not too much where you're overweighting in those asset classes, if that makes sense.
Yeah, it does. I'm thinking of some like a recent prospective client, or just someone who wanted me to look at their portfolio, and I looked, and they had some individual stocks, and it was some of the name brand. Everyone knows these companies, and then they had an S&P 500 index fund, something else tied to the Dow, and they felt like they were diversified because they had all these positions, but it was all super concentrated, kind of in one area. So you're saying it's helpful to own the entire market. Again, Kenny, I've taken this from you. I liken it to a recipe for cookies or cake. Right? You're going to have more flour than you are the baking soda, but it's the right ratio of all these ingredients to really let that recipe pop.
Yeah. So anytime you're building a portfolio, to kind of expand on the idea before, the reason we diversify is kind of twofold. One is to eliminate a singular dramatic drop. So, if you hold one stock, it can go to zero. Everyone kind of knows that. We use the Enron example or many, many others. The other is to be invest in a way where you're going to experience a drop that's going to be for a prolonged time period. And that's really where the diversification outside of asset classes comes. Because someone could say, okay, I own the S&P 500. Well, that's 500 stocks. I'm not taking on that singular risk of a company failing. I have 500. And to that person, that's absolutely correct. But what we actually see is a lot of these different asset classes, and why they're defined as asset classes, is that they tend to move together. So a lot of these large US growth-oriented stocks tend to move similar to one another. So the reason the small cap stocks and the international stocks are important is that there are times where the S&P 500, all goes down together and it stays down together. The early 2000s, that first decade of the new millennium, is a great example of that. The S&P 500 was down 9% for the decade. Whereas if you look at small stocks, the Russell 2000 was up 40%. The Russell 2000 value was up 121%. So those are the areas where, if you're in retirement and drawing off of your assets and you have a 10-year period where your portfolio is down, that can be really harmful. But if you have some portion of your portfolio that isn't down or isn't down as much for those time periods, that can be really beneficial in order to be able to draw off of kind of what's up and not selling what's down, and overall, increasing the longevity of that portfolio.
Yeah. Well, Kenny, believe it or not, we're already getting close to our 10-minute mark, so I'm going to start to wrap us up. I think of a quote. I don't know if it's attributed to Brian Portnoy or someone even before him, but this idea of diversification, and diversification means you always have to say you're sorry. There's always going to be winners and, quote unquote winners and quote unquote losers in a portfolio. And that's okay. In a well-diversified portfolio, you want these different asset classes, international, US, large, small, growth, value. I mean, these different classes or indexes to be moving differently, to sort of carry it, through, especially through retirement. So Kenny, thank you so much for joining, and look forward to our next conversation.
All right. Thanks, Dan.
Thanks.